of you and with the regulators. As in the past, we'll share with you the latest reports from the central banks on corporate deposit levels, what our clients are telling us, and discuss key game changers with our panelists and get their views on the implications for you and the market. And there's no dearth of topics for us to discuss, whether it's divergent central bank monetary policy strategies, is it tapering or is it stimulus, conflicting signals on money market fund regulations, getting into the details of Basel III, then where will your deposits go, and interest rates rising. We will also be presenting findings from our semi-annual survey of liquidity practices and plans. A quick review of the next 50 minutes. Tony's going to share the latest reported cash levels. I'll review the key highlights from our cash survey and introduce the game changers and the panel. Then Tony will facilitate the panel and I'll wrap up. A word before we get started. Our 15 minutes today gives us no time for Q&A. However, we want to take your questions, so please type them into the question box in the bottom right-hand corner of the screen, either during or at the end of the webinar, and we'll circulate the answers to all who have called in. So Tony, what are the central banks saying?
Thank you, Moni. The central banks are saying quite a bit. In fact, we have a lot to talk about today on today's agenda. And I think for the first time, I think in our 11 cash briefings, we actually see very, very different statistics, both in terms of corporate cash and in terms of central bank reserve levels. We're actually seeing a big divergence here. And obviously that is creating concern and opportunity on the mostly concern at this point on the part of corporate treasurers on just what to do in this environment. Fortunately, we have some experts with us today who can really help answer that question. Yeah, a couple weeks ago, the U.S. Announced its corporate cash letters for the year, corporate cash levels for the year ended December 31st, and again, for the last quarter, they were up 3%, nearly $2 trillion, which is up 12.5% year over year. One of the steepest year-over-year gains, as you can see in the upper left-hand chart there, since we began looking at this in mid-year 2000. So corporations in the U.S. are clearly holding on to cash, up 3% in the quarter, 12.5% year-over-year. If you look to the right, though, in the UK, after a very aggressive increase in cash through 2012, corporate cash in the UK has kind of leveled off and is, for the last 3 quarters, has been in a fairly narrow range at about 530 billion pounds. That number just came out on Friday. Now, the Eurozone, you actually see a different chart in the bottom left, where during the past decade there was a ramping up, but then starting at about 2.5 years ago, there's been a real leveling of corporate cash in the Eurozone. And then when you look at Japan, unlike the other 3 charts, we see a fairly level pattern over the first part of the past decade, and then ramping up over the last several years, almost the mirror opposite of the Eurozone. So clearly what we're seeing here are behaviors that are beginning to differ by region. And in fact, if you look at the next chart where we show the regions all together and indexed at 100 in the beginning of the year 2000, you can see here the Japanese corporate cash lagging the entire beginning of the series, but beginning to accelerate at the end, whereas the U.S. lagged behind the gains in corporate cash in Europe and the UK, but are now catching up and moving aggressively. I think one of the best measures is when you look at corporate cash in a region as a percentage of that region's GDP. And for those of you who have attended our last several webinars, you saw U.S. corporate cash fairly stable. In December 2000, it was 9% of GDP, and up until just a few quarters ago, it was only 10% of U.S. GDP, but it is now moving up at, an economist might call it a blistering pace, as a matter of fact. The Eurozone, UK, and Japanese markets were all at a much higher percentage of GDP and had moved up. Well, the Eurozone and the UK had moved up earlier in the last decade and had begun to taper off a little bit. Japan continues to move up. So, it's clear that corporate treasurers in different jurisdictions are pursuing different strategies here. And we'd like today to explore why that might be the case and what a corporate treasurer is to do in the face of potentially higher interest rates, stimulus in one jurisdiction, tapering in another jurisdiction. But I think one thing behind it is the action of the central banks. And if we look at the chart where we show reserve balances at the central banks going back the last 8 years, we see three very different patterns on this first chart, where in the U.S., reserve balances have gone from literally $40 billion in mid-2008 up to $2.5 trillion. It was from 40 billion to 2.5 trillion today. Now the U.S. announced a tapering program, and if you look at that chart very, very, very carefully, you can see that last data point. The upward slope is just slightly less than it was the prior quarter. That's what the tapering is about. Now eventually we'll see that slope begin to flatten a little bit more. But the point is, even with tapering in the U.S., reserve balances are increasing at an incredibly fast pace, and it's interesting that the quantitative easing in the U.S. that began in 2012 was targeted at $85 billion per month, and has slowly tapered down to what is now a target of $55 billion per month. And if you look at the increase in reserve balances at the U.S. Federal Reserve, we see almost an identical increase of about $85 billion or $80 billion a month. And what that tells us is none of the stimulus is actually hitting the real economy. It's the Fed buying securities from banks, giving the banks cash for those securities, and the banks turning around and simply redepositing that money back in the Fed. So it is certainly a mystery to us here at Treasury Strategies as, like, what's the point? When you move over to the right, you can see at the Bank of England over the last several quarters, the increase that took place over the prior years has really flattened, and you might say the BOE right now is stimulus neutral. Looking down at the bottom, though, we talked last quarter about the big drop in reserves at the ECB. That has continued, and I mean, you see this huge spike going up, and there were a number of reasons, including some very specific and targeted stimulus at the ECB. But that seems to have all been drained back out. Yet we heard last week, Mario Draghi saying that now the ECB may need to begin stimulating the economy or to pursue stimulative monetary policies. So any corporate treasurer, or frankly any economist looking at these three charts has got to be wondering, my goodness, what the heck are we going to do here? And if we go to the next page, we'll find the answer isn't made any easier, or the problem isn't simplified when you add Japan and the Swiss National Bank into the equation. The current policy of the Bank of Japan is to extremely aggressive stimulus, and you can see that on this chart. And at the Swiss National Bank, they appear to be targeting an exchange rate target rather than a stimulus target, and that seems to have flattened out over the last 5 quarters. So together, when you look at these 5 charts, what we see are huge capital flows. I mean, we're talking hundreds of billions and trillions of whatever currency you choose to measure these things in, and as corporate treasurers and as bankers and fund managers, we're all kind of in this trying to figure out what is going to happen. Part of the answer to that, Moni's going to cover right now. Treasury Strategies talks to our corporate clients regularly, and we consult with some of the world's largest global corporations. Moni will share some of the insights of those conversations.
Okay. Thanks, Tony. So as Tony mentioned, and as I mentioned earlier, we recently went out to our clients via our LinkedIn groups with a short survey, really only 5 or 6 questions, regarding current plans and practices and expected changes with regard to cash balances. Now, this first chart looks at expected changes in cash levels. Before we look at the chart, though, I just wanted to note, we've been doing this for a while now, so we're able to share the year-on-year comparisons. And also, I think the thing to note, and really noted it last time, the results for several years now, or at least for several surveys, reflects a shift. So we're not seeing the dramatic changes and expectations we saw right after the crisis, in the few years after the crisis. So it's leveled out, with most companies having achieved a level of balance, working capital efficiencies and maturity and risk appetites. But let's see what the trends that have emerged with the latest survey. So looking at the expected changes in cash levels, you can see if you look across the top row, the rate of expected increase has slowed, and it's went from 44% in April 2013 to 42%. So that's really not really a change. So not a huge increase in expectations there. And then if you look at the second line, who expects their cash levels to decrease, that percentage, that's actually steadily declined since April of 2011. So we're now down to 17%. I think the big number, though, is the majority of the increase is really in those that expect their cash levels to remain about the same. And that's within, we define the same as within 10% of what they currently are. So not a lot of change there. Now if we go to the next, if we look at sources of cash, so positive cash flow from operations is still the biggest source, but it is declining in terms of how big it is. So from a high of 81 in April 2012 to 69% in April 2014. A slight increase in reduced inventories is a source. Interestingly, debt issuance, medium and long term, is up. And that's sort of interesting to look at juxtaposed to the level of cash balances that everyone has. And also increased short-term borrowing. So that's up from 8% to 15%. And then the others are really insignificant in terms of what the sources are. And then on the next slide, if we look at what the uses are of cash, there's really very little change here. CapEx is down a bit. Negative cash flow from operations, the same. Pay down of short-term borrowing is about the same. Acquisitions, everything is really very much the same. And debt redemptions are down. They were at a high of 23% in April 2011, but now are steadying out at around 11%, expecting to use cash for debt redemptions. So if we go to the next slide. So what's happening to how corporates are managing risk? And if you look at maturity risk, there's some that are expecting to fewer are expecting to go shorter. So that may and more are expecting to go longer. So that may and about the same is up a little bit. But that says that maybe some companies are willing to take on more risk now. But slight. FX risk, really almost no change there. And then in credit risk, again, you're seeing more appetite for credit risk. So in terms of companies that expect their credit risk appetite to be more conservative, that's declined from 14% to 8%. And those who expect to be less conservative has gone from 11% to 15%. So again, a little bit more appetite for risk there. So if we go to, we have been talking now for several years about the shift we've seen, and this was particularly pronounced after the economic crisis, but certainly seeing Treasury as the financial nerve center of the organization. And the results when we ask treasurers in terms of what their management practices are really do reflect that. So when you're the center of, when you're the financial nerve center of the organization, you certainly need to have a handle on what cash you have or expect to have, and you need the technologies to help you look at that. So there's, in terms of increased reliance on cash forecasting, 50% plan to increase their reliance on it. That's at 39% today. That doesn't mean fewer companies are relying on it, just fewer companies are expecting to increase their reliance on it. So it may be an indication that companies have done as much as they can with forecasting at this point. And then implementation of new technologies, that's gone up slightly. 35% expect to increase implementation, and that's really borne out by what we're seeing in our technology practice. And then both for formally modifying investment policies and formally modifying risk management policies, both of those numbers are up. I think what we see in general is that companies are regularly looking at how they're managing their policies, and they're more frequently updating them now to account for all the changes and the uncertainty in the market. There's much more frequent changes of those policies, so none of this is a surprise. And then with this survey, we asked our last question, if you go to the next slide, and the next slide, we asked an open-ended question. We asked them what was on their mind, or what were they seeing, what were their thoughts about what was happening with liquidity? Did they have any concerns, questions, or insights around the market? And I don't think any of these are surprise. If you look at the quote over to the left and the black call out, it says, with rates so low, holding most investments does not make sense. You're not compensated for the risk. It's better to pay down debt as quickly as possible, and that's much better yield than holding commercial paper, et cetera. And then also, if you look in the lower right, the large box there, as rates begin to rise, it will be even more critical that we have a clearly defined liquidity strategy and that the necessary tools for managing liquidity are maintained. So including cash forecasting, technology, banking structures to support that visibility, and that's very much aligned with what we saw on the prior chart. So no surprises here. Now, if we turn to the next slide, I'm going to just briefly introduce the game changers, but then we're going to go to our panel. So I will leave this for Tony and the panel to discuss, but if you can roll forward to the game changers slide, what we're going to discuss and what the panel is going to discuss, and Tony's mentioned and I've mentioned, so we think these are really very interesting topics. But again, central bank policies, tapering or stimulus, so getting mixed messages depending on which jurisdiction you're looking at or operating in. The Basel III implementation, getting into the details, so we're seeing more corporates really paying attention to what the impact's going to be, more banks spending time talking to the corporates about what the implication is. Money market fund regulation, there's conflicting signals. Europe has kicked the can down the road, and the SEC unexpectedly extended the comment period. And then where will deposits go? On the last CAS briefing, we all saw that at year end, there were some companies having a hard time finding a place for their deposits with their banks. And then what's going to happen when interest rates rise? So, an interesting group of topics for us to discuss with our panel. And before we turn it over to the panel, let me introduce our distinguished panel. So we have Martin O'Donovan, who's Deputy Policy and Technical Director at the Association of Corporate Treasurers, the ACT, where his responsibilities include provision of technical guidance and regular updates to the members, as well as representing the views of treasurers to government, regulators, and standard setters. The ACT is a professional treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Sue Hill is a Senior Vice President and Senior Portfolio Manager at Federated Investors, a leading investment management firm and pioneer in money market and fixed income funds. Sue is responsible for portfolio management and research of government money market funds. And then Ian Rasmussen is a Senior Director of Fitch Ratings, a leading global provider of ratings, commentary, and research. As Director of Funds and Asset Management Rating Group in New York, Ian is responsible for Fitch's U.S. coverage of money market funds, closed-end funds, local government investment pools, and asset managers. In this role, he's responsible for assigning ratings, developing rating criteria and models, and publishing timely research on analytical and regulatory developments affecting these industries. So again, a great panel. And Tony, I'm going to turn it over to you to facilitate the discussion.
Very good. Thank you, Moni, and welcome to our guests. I think picking up on what the Treasury Strategies clients are saying that Moni discussed, there were several comments there around sort of anticipation of an expected rise in interest rates. So maybe we should start with the game changer at the 9 o'clock spot on the dial there, when interest rates rise. And the challenge that our clients are talking to us about is, should they begin to change their investment policies now? Should they change their investment strategies? As we saw, Moni showed from the survey that some companies are going a little bit longer in their maturities on the investment side, and and fewer companies are shortening their maturities. That would indicate a little appetite for risk and perhaps anticipation of a rate increase. But we are seeing differences in different jurisdictions around the globe. So I would like to start with the first question to Martin. Your constituents are in dialogue with you all the time. How are they anticipating potential changes in interest rates? And the question is not only from the investment side, but also from the borrowing side.
Well, I think, in the investing side, probably the expectations are that rates will actually stay low for a little while yet. I mean, that lengthening out of maturities that you've flagged is probably more just a risk tolerance, and therefore going out a little bit further along the yield curve to pick up a tiny bit more yield. I mean, previously people have been very risk adverse and keeping everything sort of almost overnight in 1 week. On the borrowing side, I think it's a bit more strategic, in that people are concerned about rates going up. Could be a while yet, but the longer term rates now are just so attractive in absolute terms that you'd almost be a fool to miss out on it. And what we're seeing is a lot of companies are moving their borrowing portfolio very, very heavily towards fixed rates for a reasonable length of maturity. The bigger companies having sort of 18–90% of their debt fixed, or even getting over 100% of their net debt fixed, where you've actually got companies that have got cash. So I think there is that concern to hedge against the rise that will come at some stage.
So you're talking about that really at two levels. One is fixing the rate, and then the other is the actual maturity structure. And both of which I think you're indicating companies lock in at fixed rates for longer maturities.
I think that's right. It's both of that, because locking in a fixed rate for just 2 or 3 years doesn't really get you very far if rates are actually going to stay reasonably low for that period. It's trying to look further forward and hedge that.
Now, Sue, as a portfolio manager, you're confronted with many of the same questions as corporate treasurers. How are you looking at sort of the anticipation of higher rates at some point down the road?
Sure, Tony. Hey, it's been so long, really, since we've had to deal with interest rates at the front end being higher than where we've been. But so we're kind of coming to grips with a shift in our general approach to how we're viewing the market. But the transition to monetary policy, I think, in the U.S. really is at hand. We don't know how it's going to play out. or how long it will take, or really, how the Fed is actually going to implement it. But, tapering's underway. It's likely to end by the end of this year. Rates will rise at some point in our lifetime. So we're beginning to make adjustments from an investment perspective accordingly. I wouldn't expect it to work into our markets in the 2a7 part of the curve until a couple months down the road, when the long end of our investment spectrum starts to reflect a Fed tightening in 2015. The very front end of the yield curve really is driven by what the Fed does, and what the Fed specifically would do with the overnight reverse repo facility. But it's definitely on our minds to make the shift. We're looking a little bit at the value or lack of value in longer-term securities in light of our expectation that it'll begin to price in tightening before too long, and starting to make more conservative investment decisions as a result.
So you're suggesting that the pricing or the anticipation may be priced in before the actual central bank event?
We would expect that to be the case. That's the way that it's been in normal tightening cycles. Now, I don't think anything about this particular unwind process will be normal, will look like what we've seen in the past. But we would anticipate that when the Fed is expected to begin to raise short-term rates, that we'll begin to see that priced into securities that are a little bit longer in duration first. And I think that's typically how we've seen it, and would expect to see it in this particular case. So how you assess value really depends on how much of a tightening is priced into that security relative to what your own expectations are. Our firm's view is that when the Fed does start to tighten, it's likely to be at a gradual pace, and they'll do all that they can to communicate their intentions. So we take that into account when we look at the types of securities that we have available to us to purchase within our portfolios.
Excellent. Now, Ian, Sue sort of indicated this unwind isn't going to be normal. It's not going to be like anything we've seen in the past. Coming from a ratings firm, that must give you a little bit of pause.
Yeah, I think it certainly does. What is interesting, though, and just to echo some of the comments that Sue made, and what was part of your presentation earlier, is that on the very short end of the curve, when we monitor money funds, for example, the interest rate risk that the money funds have by regulation, by mandate, is very, very low. Money funds can't go over 60 days weighted average maturity. We've seen funds keep kind of far away from that 60-day maturity, 60 days threshold anyways, but we've seen very, very stable weighted average maturities throughout the whole year. So it doesn't seem like fund managers at this point are gearing up for big increases at the very short end of the curve, at least at this point. And I think investors have been doing the same thing. We've in the slide earlier that you showed, it talked. I think 3 people said that their biggest concern when they're investing is liquidity. And so when you're trying to make a trade-off between, do I want to increase in yield and go a little bit further out the curve, I think most investors are still saying there's not a lot to be gained from doing that, especially in the very short part of the market where most corporate cash investors would be at. So I'd like to keep my money very short and very liquid. That's a much bigger benefit for me.
So if we have a market where everyone is short and liquid, but sounds like a finger on the trigger, things could move quickly when they do start to move. And that takes me into sort of the second round of questions regarding central bank policies. And what we saw in those earlier charts were sort of the spike in bank reserves at the U.S. Fed, but beginning to taper a bit, a spike up into the stratosphere in Japan, leveling at the Swiss National Bank and at the Bank of England, and then a plunge, almost a 65% plunge in reserves at the ECB. That says that around the world, the major economies are pursuing widely different strategies. Sue, does that create confusion? Does that create risk for investors and borrowers?
It actually just creates a little bit of uncertainty. The U.S. is just in a different place, really. I think a little bit ahead of the, ahead of the game in terms of the unwind of monetary policy stimulus. I would expect that other countries will go through the same process, down the road as things unfold. So we're really at the forefront of it from the U.S. perspective, and we'll see higher rates in our world, in contrast to relatively steady or even lower rates, when you step outside of the U.S. And I think as long as investors are conscious of that and the different, sort of paths that rates might be taking, then that could fit within an overall investment strategy. Again, the dominant theme for us in terms of discussions really is on the potential for rising rates in the U.S. and the types of decisions we're making as a result, and how the world might look a couple months down the road.
Ian, at Fitch, you're looking at money funds in jurisdictions around the world. Do those charts and the divergence in reserve balances concern you, or do they translate into sort of a different world for money funds in different jurisdictions?
Well, I think most of the rated funds have very similar limits to the types of risks they can take. And so within our rated portfolio, we actually see a lot of stability in where the fund managers are throughout Europe and the U.S. So, when we look at the ratings that we have outstanding, I don't think that there's any pocket in the jurisdiction where we feel like there's especially a concern because a group of funds are behaving very different from the rest of the portfolio ratings that we've assigned. So I would say no. Everything typically has been, most managers are keeping their portfolios very liquid, high levels of daily and weekly liquid assets. The weighted average maturities are off the highest, like maximum amounts they can do. I would say they're managing very prudently across the U.S. and Europe.
Interesting. Now, Martin, your members are treasurers domiciled in countries from around the world. Do you see any regional differences in the issues or concerns that they discuss with you?
Well, I guess each region and each set of economies is at a different stage of the cycle, and we talked just recently now about interest rates. I mean, the really crucial element is what does all this central bank stimulus do for business activity, and the fact that they are stimulating the economies around the world, if you like, is providing a sort of hedge for companies that through that stimulus it's keeping business activity up, which is absolutely the crucial thing. So no, I mean it's doing what it's supposed to do, and sure, it will get reined back as and when the stimulus isn't needed.
Interesting. Now, moving on to Basel III. At Treasury Strategies and our consulting practice, we're beginning to see a shift in sort of the corporate treasurer's understanding of what Basel III might mean to them, and I think that's coming at least in our large regional and global bank marketplace from a shift from the understanding of the rules, and now the banks are beginning to embed some of the rules in their business processes. So finally, the consequences of some of these regulations are beginning to land on the corporate treasurer's desk. And what we're hearing is a shift from concern about capital ratios and leverage ratios now to a concern about the liquidity coverage ratios and stable funding ratios, which basically say to a bank that not all corporate deposits are created equal, and some you want and some you don't want. So as this plays out, there could be a shift of deposits among banks with different appetites, or from banks into other instruments. Well, let me start with Martin again, since we were talking about this earlier in our prep for this. What are your clients hearing from their banks regarding things like LCR and NSF?
Well, the liquidity coverage ratio is certainly playing out on the bank's appetite and behaviours. Basically they do want corporate deposits rather than interbank deposits, so that's good news, except that if it's less than 30 days, it doesn't really serve an awful lot of purpose for them. So they're seeking longer term deposits, and by and large corporates prefer to keep things fairly short, so there is a little bit of tension there. But you are seeing this sort of boundary at the 30-day level, and then again in the UK we have another threshold at 93 days, so that deposits longer than 93 days count for more in terms of liquidity, and therefore banks are particularly keen to and will pay up for those. This is coming through also in various structures, so-called evergreen structures, a sort of incentive for corporates to keep their deposits rolling on. And in a way, that's something a corporate can help them with, because a fair number of cash balances are semi-permanent anyhow. But if you have to give notice, whatever it is, 30 days or something, to get hold of it, that gives you an element of flexibility while benefiting from providing the bank with funding for periods that could go on longer.
Yeah, that's very interesting. At Treasury Strategies, as we look at this, the utility function of a corporation with respect to cash is different than the utility function of a bank. And the regulation is changing the balance there, but there's a win-win if corporations and banks can establish a mutual understanding of the deposits that a corporation is going to place at the bank and the coincident volatility or stability of those deposits. So that's been fascinating for us to look at. I want to move on to money fund regulation because, again, we're getting conflicting signals here where it looked like we were about to see fairly significant rules coming into place. The European Parliament kind of deferred on the issue and now will not take it up in the current Parliament. So it may come up when the new Parliament convenes after the elections. In the U.S., the SEC about a week and a half ago came out with an additional request for comment that further postpones their rulemaking. Just as an FYI, by the way, at Treasury Strategies, we submitted a paper to the SEC on Monday in response to their request for comments. And what we did there was we took a game theory approach to money market fund regulation, and using some advanced analytic techniques within game theory, attempted to play out what would happen mathematically based on utilities and elasticities, and tested the validity of each of the SEC's proposals. And if any of you would like a copy of that paper, simply email the address you see there on the screen, and we'll be happy to send that to you. But since we have some money fund experts right here on the panel, let me jump directly to them. And I think I'll start with Ian. So, as someone who rates money funds, what do you think this means on the regulatory front, with the SEC asking more questions and the European Parliament actually kicking the can down the road?
Well, I don't think, certainly at Fitch we weren't expecting any of the reform to actually come out in the very short order. So I think it just shows that we still have some time before the final reform comes out. We will. So our current ratings, they currently speak to how the funds are managed now under the current regulatory framework and per our own rating criteria. And I think as money fund becomes certain and money fund reform becomes certain, it comes out, we may have to look to see how that might change the way that we would evaluate funds. We're not certain that that would actually cause us to change criteria, but we'll need to evaluate it. But I think maybe from the corporate treasurer's perspective, you just got done talking about Basel III and then money fund reform. I think, you know, these are very clearly the next chapters in evolving cash markets, and the very big changes in cash investments and supply for cash investments that we've experienced over the last few years. And so maybe if I had, you know, any suggestions, it would be that corporate treasurers need to be focused on making sure that their investment guidelines are reviewed regularly and are ready or start to anticipate some of the changes that are coming. You know, if banks, because of the liquidity ratio and Basel III pressures that they're facing, are not willing to engage in corporate deposits like they have been in the past, and money from reform changes the nature of, for instance, prime money market funds in a meaningful way, they're going to need other investments. And I think it's important that corporate treasurers start to think about that and how their investment guidelines currently may prohibit them from being able to change investments and to go into new types of securities offered, or you know, just what the impacts would be if you know, banks are no longer willing to have deposits at the same levels and money funds change in a meaningful way.
Well, that sounds like great advice. Now, Sue, at Federated, you are certainly on the front lines of the regulatory debate, both in the U.S. and around the world. Could you share with us a bit of your perspective on where things stand?
Sure, I'd be happy to. Obviously, as we've identified, the European money market fund reform has been pushed off for a bit, and we view that, you know, positively from our perspective, because we think it gives additional time for things, you know, in the U.S. to play out, you know, hopefully as we would like them to. We are kind of in a waiting period from the SEC's perspective. They did release 4 studies within the past week or so, which I think largely was in response to prior criticism about, you know, a failure to provide adequate analysis in terms of their underlying decision process when they make reform or make regulatory decisions. I'm not sure they've actually accomplished that based on the studies that were released, because if you do pick them apart, there's still some fairly significant holes, but it is open for an additional comment period, as you've mentioned, which brings us at least to the end of April. We would expect, as Federated has done in the past, to you know, comment on each of those analyses. You know, you can look at it and try and figure out what it is that the SEC is thinking about what their ultimate decision will be, but I think that it reads a little bit too much into what the releases actually meant. I think all it really does is pushes a decision down the road even further. You know, originally I know some had thought maybe the middle of 2014 could be the time that we'd see a final ruling from the SEC. I think that's more likely, you know, towards the end of the third quarter or even beyond at this point, as the SEC needs to have time, adequate time, to evaluate the responses that it gets in response to this latest comment.
And Martin, from your approach in the UK, what's your take on this?
Well, I guess, you know, we have more time to see what's going to happen. So the rules, you know, across the globe seem to be, or the rule changes or potential for it seem to be pushed back. So a little bit, I think, wait and see. I mean, I think that in a funny sort of way, the longer it takes to make whatever changes, and if they get watered down a little bit, it just makes it that much easier for corporate treasurers to adapt to them, either because they've had more time to get used to them, or that the changes are hopefully less radical.
So by the time it's news, it's old news.
In a way.
Okay, which brings to I want to do a quick concluding question here, and that is with Basel III causing banks to view volatile deposits or non-operational deposits less attractively, and money fund regulation potentially making money funds a less attractive tool for corporate treasurers. Is there a place for the money to go? And let's go around real quick. Sue, is there a place for the money to go?
The toughest question, and you come to me first. It's a difficult thing, right? Where we're struggling from the money fund perspective with from an investment perspective with the same things that the corporate treasurers are of where to put cash in a world of decreasing supply. I do need to point out that the regulatory reform is centered on only at this point increasingly small component of the overall money market industry. So money market funds, I think, will still be an available alternative for cash investment even in the world as we go forward. But it's really, I think, innovation is what's kind of keeping us going when I'm looking to invest in in products, because of the liquidity coverage ratio pressures, we're seeing different types of structures than we've seen in the past. And so there's, motivation to invest in different, product types to the extent that makes sense within an overall portfolio. I think from a corporate treasurer's perspective, it's the exact same decision process. You'll likely to see alternative products crop up to work around the bank regulatory influences, and just need to be a little conscious of how you evaluate these products in a changing world.
Gee, I had expected you to say the money will go into a federated ultra-short bond fund.
Well, we'd like to see that too, and certainly or alternatives to the money market space.
Right. Ian, where do you see the money going?
Well, you already mentioned the ultra-short bond fund, so we've seen managers start to create products that could maybe fit that in-between place between prime money funds and maybe just go out a little bit in duration beyond what they're able to do under 2A7. So that could be an option. Although in speaking with managers, it seems like investors haven't been, at least in droves yet, going into those products. I know that investors are also interested in separately managed accounts where they might have cash that they can put out for an extended period of time, and they can set up with the manager very specific maturities and liquidity and that kind of thing, depending upon their needs for cash. That certainly is a viable option. Just another to Sue's point about just new products coming on. This one isn't the most exciting new product, but the Treasury has been issuing FRNs this year, and we saw participation from money funds was actually quite low at 22% during the second auction, up from 11% at the first auction. But maybe investors are just buying Treasuries directly now that they have a floating rate security to do so. So maybe corporate treasurers are just looking to invest directly into markets themselves.
Well, the FRN point is very interesting, and I think we might make that a separate topic in next quarter's briefing. The Treasury strategies, we have some very strong thoughts about how FRNs might actually be disruptive to the marketplace, but we'll hold that thought till next quarter. Martin, a closing thought.
I think there's still some good life left in money market funds, so in whatever shape they morph into. So they'll still be popular. I'm sure we'll see new products and treasurers will want to evaluate those. The one that is not a particularly new product, but is perhaps new to some treasurers, is investing in repos, where you just put a deposit with a bank but get back some form of security or collateral. We're seeing those becoming a lot more popular. They've got a huge number of merits, which I won't run through right now, but definitely something for people to be thinking about.